Hi, everyone. My name is Ian McAfee, as Matt said. I'm a founding partner of Shift Forex. I'll be moderating the first panel today, which is about global industry growth trends. We'll be discussing things like regional growth, product growth, inhibitions to growth, and various aspects that affect the FX industry and the growth over the next few years. Speaking on the panel will be Ralitza Fortunova, Executive Director at Nomura, Bill Goodbody, Managing Director for Knight Capital, who oversees Hotspot, David Nunes, Chief Operating Officer at Kernex, Gary Weiss, President and Chief Operating Officer at IBFX, and Joe Conlon, Global Head of Sales for FC Stone. We're just waiting for them to get mic'd up. Looks like they're on their way now. Yeah, good. Wanted to thank the panelists for speaking today, and I'll just start off by talking about something that affects everyone here, volumes. We saw a decrease in 2012, and wanted to talk about how much of this was a factor of lower volatility, or were there other aspects that affected that? I'll have each of the panelists address this, and we'll start with Ralitza.
I think that we all agree that 2012 was a very difficult year in markets across the board, particularly in FX. There was definitely reduced volatility. You saw investors taking their funds away from foreign exchange into other asset classes, or simply holding much longer term view. Dollar yen trading in a very tight range probably didn't help that. One of the things that we found difficult as a market maker was in terms of the reduced volatility, being able to continue to monetize our client flows in that environment proved difficult. Being principal to our flows and idea generation was something that we found complemented our market making business. Another factor that we can all speak to is fragmentation in the foreign exchange world. That's something that we could look to, and some people can say did contribute to the reduction in volumes. I would tend to disagree with that. I think that most market participants are connected to different pools and have access to and visibility of most of the liquidity that was available.
Thanks. Bill, you want to take a shot?
Sure. I can make a comment there. I mean, I think for 2012, it was definitely a very interesting time. As a platform operator, it's hard to make people want to trade. We do our best that we can to entice them to do so, but there's very little we can do as far as really, getting people to trade and trade more actively. So when you have a period like last year, you really just have to sort of hunker down a little bit and execute on your game plan. So from our perspective, and I'm sure a lot of other participants here, it's signing up new clients, it's making sure more and more people are hopefully on the platform every day. It's trying to find ways to pick up market share, and so I know in our story, we saw we were able to execute on that and pick up market share in a down year, which we think sets us up for a more positive experience as markets return, which we're already seeing here this year. In that kind of environment, though, again, I think it's really just sticking to your game plan, sticking to the value proposition that you bring to the marketplace, and I think we saw that. I would agree with what Ralitza said, that I don't think fragmentation, and certainly all the announcement of platforms last year or the last 18 months is impacting volumes in a negative way. I don't think it's impacting platform volumes in a negative way. Everyone's got to get out there and tell their story and add their value proposition. I know we don't see it. I don't know, David, maybe you see something similar. I'm not sure.
Yeah, I think last year was very interesting because I think that's sort of an environment where you're under tremendous pressure to sort of maintain your profitability and maintain your revenues in an environment which is significantly challenging. Gives you the opportunity to I suppose, separate the men from the boys, and that if you can make the most of that, grow market share in that difficult environment, then when the market comes back, obviously you're in a very, very good position to take more advantage of that. So we invested very heavily last year in technological innovation, and that wasn't just something that we did. We saw that a lot of our participants on the Kernex platform were we're also investing heavily in building new models or new infrastructure, or anyone who wasn't proximity hosting ended up by doing that last year. So it feels to me like the uptick that we saw at the beginning of this year was very much a factor of the fact that the market was spring-loaded to some extent. So when the volatility did come back, the volumes sort of shot up in a way that wasn't necessarily perfectly correlated to the increase in volatility. The volatility hasn't come back to where it was sort of at the beginning of last year. It's kind of come back to where it was sort of halfway through last year. So the fact that the volumes increased so much is a very interesting sort of aspect of that, I think. And it didn't also help the fact that in the non-FX market, there was obviously a big flight from risk, and that meant that the real money guys didn't need to trade FX to cover their positions. They started just doing large rolls. So we saw on our Connect platform that a lot of the volume was moving from being outrights to being swaps, which again then feeds through to the FX market and then depresses activity there as well. So it's like a sort of a vicious circle that was going on there. But
Great. Gary, any thoughts on the retail space?
Yeah, it's kind of an interesting comment, and I echo some of the thoughts that the others have said. But in the world of retail, you actually have a number of different layers of retail, if you want to call it that, because you have the serious guys, and you have the kind of people who just show up. And when you have a year like last, the people in that latter group, the ones who just show up, just generally don't. So as a practical matter, you get more, let's call them the serious type of traders, the ones who are system followers. Volume contracts as a result of that. And the good news with it is that, once again, you have those that will follow the type of systems that certain platforms are made to really handle. And as a result, you do tend to consolidate that into your core customer base. We feel like, from that perspective, we and others probably in the retail space are probably pretty well positioned as it came out this year, because the less, let's say, serious traders, the more kind of generalists are starting to show up again, because it's in the news. It's something that's kind of current now. And as a result of having survived last year and put things in place and pretty well kind of consolidated how your operations work, I think we're in a good position. And I would say that's probably the case with most retail platforms at this point.
Thank you. Last but not least, Joe, you want to comment on FC Stones?
Well, last year, coming into January last year, I think a lot of people were predicting really high volume year. It seemed that Spain was going to be the inflection point for the euro breakup, and that didn't happen. And I think that was a big story for the rest of the year, as a lot of central banks then kind of did things that created low volatility, and people started feeling more comfortable about where the exchange rates were across the board, and that just, that gives fewer people the impetus to do the trading, that they create the high volume. I think another thing is, I think a lot of the banks like Nomura or whoever came up with better algos to make prices, and those actually stopped a lot of the algorithmic traders for generating the high volume numbers that they created over the last couple of years. And I think the third thing is regulations started filtering in, primarily in retail. I mean, as the retail brokers started to get really crushed with some of the regulatory, we'll call it overhead, they started focusing on that and less on marketing. And at the same time as you got this compression and volatility, it really had a compounding effect.
And just thinking, looking forward, and David, you touched on this a little bit already, we've seen some pickup in 2013. Do you view that as back to smooth sailing pre-2012, or are we kind of limited to, or are we kind of, do you think we're in a different environment now? Melissa, do you want to take that one?
I think the volatility has definitely returned. We're seeing there's a few factors that have helped that. There is still instability in Europe. However, we are seeing all kinds of clients come back in the game. There's positions that have definitely been put back on. Dollar yen breaking out of the range definitely helped. What comes with that, though, is there isn't really, I don't think the volatility will necessarily die off. I think we saw that this past weekend with the events in Cyprus. The reflection in that in the institutional vol market was Euro vol jumped by 2 points just over the weekend. So I think that those factors will continue to drive volatility, and I don't see an end to that anytime soon.
Yeah, I mean, I would, from our perspective, and again, I think most people would share this, probably share this view. I mean, I'm not an economist, so I'm not going to predict, where volatility is going to go this year. But I think if you're looking at sort of the macro environment that we're in, the likelihood of any real solutions or dramatic changes to that environment in the short term are pretty unlikely, which makes it, I think, a very exciting time for the marketplace. That that should continue to fuel volumes. Again, you never know what on any given weekend what the next story is going to be. I think everyone definitely took a little bit of a breather. Certainly the second half of last year, and now it's right back at it again. So I know we're very optimistic for what 2013 holds. I mean, we're already seeing, on our platform, I think we've seen a lot more, again, of this time that was spent in retooling technology and upgrading technology really starting to bear fruit. We've seen a lot more activity from a lot of the bank side in particular, where I think, again, they've changed their models, upgraded the technology, are really deploying much more interesting making and taking models into the marketplace, and they interact with all the different marketplaces in different ways there. But that's a great underpinning of what should fuel volumes for the coming year, I think. Yeah.
I'm cautiously guarded about whether volatility can sort of remain at the level that it's at now. I think we have the Prime Minister of Japan to thank a lot for the sort of return to volumes in the FX market. There's only so far that the yen can go. So what may happen is what we had last year again, which is these events such as Cyprus they generate volatility of volatility, which is a crappy situation for trading, to be honest. So I'm concerned that we might end up by being back there again. It'll suppress, if things like Cyprus keep popping up, then it suppresses the risk appetite outside of the FX market. The only thing that obviously glimmers of hope in currency wars obviously do exist, but again, how sort of sustainable is that in the long run? Ultimately, we're still in a near zero interest rate environment globally, which means that a lot of opportunities to trade simply don't exist in that sort of space. So until interest rates come back, I don't think we're going to be back to a normal environment at all. So we could be looking at more volatility for the next 12 months.
Mm-hmm. Yeah, thanks for not turning that into an economic forecast panel. That's later today with Jim Trott. So I'll just move on to the spreads and how they've affected growth. Spreads have been compressing over the last 10 years in tandem with increasing trading volume. There's not a lot of room left, as we all know. To what extent is this over, and are there other aspects that may take over in terms of what's next?
Well, with spreads compressing, I mean, we were talking about it at breakfast. Some of the banks are producing very, very tight spreads, but they're also producing very high reject rates. So in order to, if you're going to be able to not only produce a really tight price, you also have to accept that price, or there's no deal at all, and there's no increased volume. So I think it's great that the spreads are tightened. I think what will create a new wave of volume growth is a lower reject rate across the board at some of these ECNs or banks, et cetera.
Any other comments on spreads?
Yeah, actually, I kind of take your point on that one, Joe. It's an interesting comment because you get to the point where it's almost a diminishing return. I mean, at a choice spread market, everyone's really kind of excited to the extent it's the greatest thing in the world until they can't get filled on one side and it runs away on the side they want to be. So, it's a point of almost diminishing returns. And I think that even on the retail side, we've seen retail spreads compress pretty dramatically. Mm-hmm. But it almost acts as a kind of false situation even for customers, because they say, well, okay, spreads are great, but can I really trade on them? And a lot of times the slippage, which is the great benchmark phrase for our industry, is so severe that the comment you get back, well, I don't care what your spreads are, I just want to know I get the price. Right. So this is kind of an odd little inflection point we're actually seeing, I think, in retail. Yeah, spreads come in, but I think customers are more concerned about getting done.
Mm-hmm.
I would agree with that, and that the sort of transparency into the quality of liquidity is something which I think is sort of day has come. We in the current business are trying to provide more visibility into the performance of liquidity providers based upon exactly that sentiment, which is I want to know not just what the price looks like, but how often when I try and hit that do I actually get it. I think there's significant pressure out there to improve liquidity because there are more entrants in that space. One of the sort of the big events that we've seen over the last couple of years has been the rise of non-bank market makers in the FX marketplace, so the hedge funds making prices. And I think that the investment that they've made in terms of technology and the competence that they have around market making is a very interesting driver, I think, for the banks to look to as they don't have necessarily the same quality of performance when it comes to their liquidity, and there is now more of a selection out there to pick and choose from. So I think there is a degree of driving in the direction of better fill ratios as well as tighter prices.
You know, both you guys, both Hotspot and CurrentX, have non-last look liquidity, and it's not good. You know, no offense to you guys, but you do have people that will provide liquidity with no last look. Is it realistic that perhaps even with these non-banks that you're talking about, that we will get reasonable type prices on non-last look liquidity at some point in the next, I don't know, year or two?
I definitely think that you will. You know, I mean, you know, last look is a feature that we think it can be a great value proposition as far as adding, you know, very enhanced liquidity. It's definitely helped tighten the spreads. But you know, the flip side of that is you need to maintain the client experience. So it needs to be as virtually firm as it can be. So you know, that's something where we work with our liquidity providers, and you know, we have a mixture. Some have last look, some don't. You know, we try to maintain the benchmark to be that the response times have to be, you know, it's a bar we keep lowering on them, so that, you know, the times have to get faster and faster. Their acceptance rates has to be higher and higher. If they don't meet the threshold, they can't have that privilege. But the client experience comments that have been here, I mean, that's something we're absolutely seeing. That a little, you know, there's been a little bit of a shift away from the focus on spread because, well, again, the spread doesn't matter if you don't get it. And you know, we're already working with our liquidity providers on, you know, people who want to do larger sizes, and the feedback that we're getting, they're like, well, if you know, when I come to you, sometimes I'm only getting a small chunk of it done, and so we're working on solving that problem. And yeah, what that's going to translate into is probably a slightly wider spread, but hopefully a much deeper and more firm set of liquidity to draw from. I think you're going to see a lot of that change even within this current year, quite frankly.
I think one of the important things is, and the theme came through quite clearly, is the quality of pricing. It's very important, and I think ultimately competing on spreads and pushing spreads to actually compress even more is not the key to gaining market share. I think as a liquidity provider, both on the retail side, the ECN side, and the bank side for us as well, it's the quality of your value-add services. So may that be the quality of service that you provide, the consistency of pricing. Also, particularly on the bank side, we're looking at pre- and post-trade services, how to leverage some of the technology that we have and link that back to our clients. So that's one of these are things that are very important. That can all be bundled in the form of information. It's how you share information back with your clients and how your clients share information back. And that's something that, if you can do that effectively, that means that your market share ultimately will increase. And I think that definitely applies to the retail side, and it definitely applies to the bank side.
So in addition to spreads compressing, there's been some other factors impacting profit margins, particularly regulation. How do you foresee brokers, banks, and platform providers dealing with regulation and the cost of regulation?
Well, you know, the regulation that is being imposed more actively this year is actually changing the way we do business, who our clients are, how we process the trades of these clients, and it's a huge impact. In fact, it's not going to just come through in the P&L. You know, I think we hired more legal and compliance staff last year than we hired salespeople and traders. And that's a big overhead to carry. So even if you're able to maintain profitability with the new systems that have to be in place and the new guidelines that have to be followed, and even if you were able to close the same amount of people and get them through the new rigors, you still have a higher cost basis. So I think it's going to be a very challenging year for companies like mine. I think some of the banks have already kind of, and you can comment on this, I think a lot of the banks have already experienced some of the pain and suffering. I think this is our year for pain and suffering.
I kind of agree with that in an odd sort of way. I mean, I mentioned before that it seems like in the U.S., certainly in retail FX, that the biggest real growth industry has been regulation. And, as a practical matter, what we've seen is a transition on the regulatory side from what used to be a reactive base to now a proactive. And as a result, they've done a great job in really cleaning up what could have been considered a very kind of wild and opaque business, particularly in retail. And I don't fault them with that. But the end result has been a migration of customers out of the U.S. So the dynamic of the U.S. business as a result of regulation has really changed quite a bit. And the amount of non-U.S. and overseas business is really the growth area. And what we do, how we staff it, how we go about it, and how we maintain a presence in the U.S. is actually really quite challenging in this environment because we believe that it's going to become more, not less. Mm-hmm. And growth in regulation is pervasive. It's just going to happen.
So we've talked quite a bit about traditional factors that affect growth. There's been a few outliers in the recent years with the infrastructure challenge like Hurricane Sandy and what's going on with Cyprus right now. David being the CEO of CurrentX, I'm sure you've seen quite an impact after post-Sandy. How do you see the importance of maintaining a solid infrastructure and retaining market share?
Well, I think Sandy was very interesting. It was a very exciting week for us at CurrentX. I think for the industry as a whole, where it was an odd experience to watch the whole market end up running on diesel generators. But it all, it worked very effectively in terms of on our side, our BCP program, the sort of robustness of our infrastructure was really tested to the max. Especially, we didn't expect to lose 3 of our 4 internet connections into our primary data center. I mean, you don't ever expect to lose more than 1 at once. But we had the ability to then reroute traffic using a Velo network, which enabled us to dynamically reconfigure, and we basically ported internet traffic from one of our data centers over to the other to have at least to maintain resilience if we needed to. So I think in that given that these 100-year storms are occurring with remarkably greater frequency than 100 years, it's going to happen again, right? And I think anyone who had difficulty during Sandy will definitely be looking to see whether or not they can improve their robustness of their infrastructure. The fact that we can't close the market like you can do in equities and bonds just took holidays. We haven't got the luxury. It's a 24-hour market, and I think that's actually quite interesting that the FX market managed to actually withstand the impact of Hurricane Sandy. So actually, it's held to a sort of a higher standard to some extent than other asset classes, and I think it did pretty well considering.
Absolutely. Any other comments?
I mean, I would just say, our experience was, again, you had to, coming out of that is that I think most businesses, certainly any in this part of the world that, that dealt with it head on, will go back and retool all their business continuity plans. I think everyone was faced with scenarios, like David mentioned. I mean, the logistics of all of a sudden worrying about, can your fuel truck make it to refuel your generator? After 48, 72 hours, those are not things you normally were considering, but now that's sort of front and center. I know we certainly had an issue with that, and dealing with a staff that can't physically get to your normal location or your BCP location, and their cell phones are running out of power. How do you deal with that? I think again, the industry and certainly all the participants in this region were able to manage that and really create an uninterrupted marketplace during that time, which is quite remarkable. But you need to take that and you need to learn from that and come up with new plans, because there's always a different scenario. And again, that's more likely to occur with greater frequency, unfortunately.
We never really envisaged people. We had our technical operations staff driving towards data centers, inching forwards as the floodwaters receded, whilst logged into our VPN via MiFi connections from within their cars, reconfiguring our network via their laptops. I mean, it's not really a scenario that you think, I must be able to do that. Because that's just, it's kind of beyond your wildest nightmares when it comes to a sort of an apocalyptic financial scenario.
Yeah, and speaking of apocalyptic, Cyprus has been happening recently, and some of the financial concerns going on over there. Gary, there's a lot of your competitors there in Cyprus, or retail brokers. How do you see what's happening affecting the perception of the retail market space worldwide, and do you think it will impact your business?
Well, the retail market space, aside from the many issues that kind of swirl around it, and adequacy of customers, regulation, and everything else, the one basic premise that always kind of comes to mind is, are my funds safe? Or if I give you my, $5,000 that, I don't want to have lost because I know I'm going to make a fortune trading, are you going to be able to give it back to me? It's a real issue. It's always something that, we confront every day. So now you've got a situation where you have government entities effectively saying, well, we possibly may confiscate, funds in what would be a regulated environment. It throws another wrench into that whole perception, and the persona of what we now have to go at, represent to customers who may want to trade foreign exchange in the retail space is going to have to be emphasized to even a greater extent on relative safety measures that we take, and the safety of funds, and the adequacy of how we run our businesses, because is really anything safe? And that's going to be the general commentary. And I think that it will cause certain things to evolve where maybe it wouldn't have naturally. We had situations where clearance became a real factor, particularly in the institutional space, and the advent of prime brokers a number of years ago probably revolutionized that. I think we could see a situation evolve in retail similarly. People are going to say, look, I want to execute with you. I like your platform. I like the EA. I like the advisor. But honestly, I may not want to hold funds with you. So what do you do then? Is there a space, is there a possibility to evolve what could be a similar scenario, some type of a clearance entity which holds customer funds, retail space, which takes in trades from multiple different platforms? This could evolve into the next phase of retail only because of things like customer uncertainty. It's something we're going to have to overcome, and it possibly presents an opportunity, but it's certainly something which will cause things to evolve.
That's a very interesting point. We get calls all the time from people that are looking to have custodial accounts with maybe a larger bank, and use that custodial money to be traded on our books. And I think it's a great idea. It's just the problem is, how do you implement it?
It's a logistics issue. There's no question, because once you start dealing in smaller amounts, the relative cost
That's the problem.
is huge.
Yeah.
So, when I say it has to evolve, it does, and certain aspects of it are not purely mechanical. I think the mechanical apparatus is probably the easiest side. It's really the cost structure.
Yeah.
How do you work the net down and the roll-up of accounts coming into a central location so it actually makes sense economically? And this could be a challenge. But again, as a practical matter, we're going to have to look at the relative value of that risk in terms of the retail space, and how do you compete with having customers trust their deposits to you?
So moving on to something a little more optimistic. Looking at areas of growth, or where there's future growth. People have been talking a lot about Asia and China, and it's a top of mind for a lot of providers. How are you approaching these regions to capture market share? And your bank is based in Japan, pretty close proximity to China. You care to comment on?
Sure. Nomura is one of the leading banks in Asia. We're leveraging that position quite strongly with approaching regions like China, also India. Particularly with China, what we're looking at is working with intermediary brokers in Hong Kong who have onshore client bases. And one of the things to note that the regulation environment in China is still not as stringent as it is in the rest of the region. So that's something that can, for the moment, work to the advantage of us and all the other participants in those marketplaces. It is important, though, that it's a low-key growth approach, if I can say that. You don't want to be in a situation where the regulators actually do have a reason to react and actually impose similar rules as they're having in some of the other countries in the region.
Thank you. Any other viewpoints on approaches?
I think from our perspective, Asia is a very critical component of our growth strategy. One of our new products really aimed towards the wholesale community, so for the retail brokers to provide a liquidity solution, and clearly there's a concentration, a very exciting concentration of those within Asia specifically, that we're targeting aggressively. I think the challenges that we face with that is how do you really try to right size that? So we've had a sales presence in Singapore for some time. We're expanding that presence. We've brought on some specialists to help us work with penetration in China. We've had some successes that have been very fruitful, but it takes a lot of time to work that. You got to get people with the right relationships, and it's a lot of patience and persistence. I think that's the approach that we're taking, but it's difficult. Whether it's Japan, whether it's Hong Kong, again, figuring out is it the right time for me to put boots on the ground or not, and taking that investment. Clearly, when you start putting boots on the ground or how you're approaching that region, you do have to always be very mindful of any potential regulatory issues you may step into, and that's something that we're watching very, very carefully. Again, right now our sort of strategy is expanding from our Singapore base and sort of using that as a sort of launching point. But it's a critically important region, and I think persistence is really going to pay off. I don't think these markets aren't opening up tomorrow to the degree we'd all like them to, but I think that investment will pay off over time.
I think, Asia is, to paraphrase Monty Python, what cartographers call very, very big. There is different countries in Asia, and they have very different regulatory environments. So I don't think you can look at Asia as this Asia, my strategy towards Asia. The regulatory environment in Japan and the sort of FX opportunities in Japan are completely different to the regulatory environment in India. And I think sort of dealing with the hurdles that you're going to have to face in those countries varies enormously from country to country, but also what's on the ground there. So the Japanese retail market is a completely different thing to anywhere else, actually. And as Coronex, we have a very, very significant retail business out in Japan. We don't have a very significant retail business in India for obvious reasons. It's just not the same sort of country. The currency is not deliverable in the same way that it is in Japan. So you've got to deal with these on a case-by-case basis. And I think that you need to have very adequate, more than adequate coverage in the areas to actually take on those countries. You can't just turn up there once in a while. You need to have boots on the ground.
Mm-hmm. I kind of echo that point, and it's interesting the way you characterize that, particularly with regard to Japan, because it is its own unique space, and Japan is very different than when you say Asia in general. We actually have a parent, it's a Japanese parent, and they're quite big in Japan. But the growth strategy of what we're doing in Asia is not uniquely Japanese, and a lot of it has to do with China. And China is probably the most, how do I describe it? It's the biggest enigma as far as foreign exchange and retail world is concerned, because realistically it doesn't exist, and yet it's huge. At the same time, and I say that because technically you can't do retail business in China, and if you look at the amount of people doing retail business in China, it's bigger than anywhere else in the world. So again, it's an enigma. What do you do? Are you there? Are you not? How much business, how much resources do you put there? Understanding that it's too big to ignore, it presents a very complex type of strategy to really approach.
I've got similar challenges as that. Do you hire a person, put them in one or multiple countries, or give them a territory, or do you work through agents, some type of introducing agents, which is then hard to manage what kind of marketing they're putting out and what kind of things they're saying. I don't think that you can cover Asia from the U.S. and send a guy once a quarter over there and make it happen. It's just not going to happen. So you do need physical presence there. And the challenge is, do you do it by hiring staff and then trusting staff will do it right, or hiring outside agents to do it and hope that they comply with the rules and regulations that have to be complied with in order to get these clients? So I've very similar challenging strategies, Gary, as you guys do.
And how about the lesser developed parts of Asia, India, Southeast Asia? Do you have any particular viewpoint on how to approach those markets?
Well, you know, on India specifically, FC Stone has done a great job. We have kind of a natural business in India because we're a large gold trading company, and Indians like their gold, but they usually buy it through offshore entities to be then settled on onshore, so they have to hedge that risk in the rupee. But the challenge is, how much risk do we really want in one currency? One of the things that our company talks about a lot is concentration risk, you know, and we can only take a certain amount of risk in any one currency. So what we have to have is more of a portfolio approach. And that's this, then I'm back to the same challenge we just talked about earlier. Like, yes, I've got this edge in India, but that same edge doesn't carry through for other countries in that region.
Okay. So moving on more to the products. People have been anticipating options, particularly in the retail space, for a while. We've seen binary options kind of explode recently. Gary, being in the retail space, do you view that as a medium for retail clients to better understand more complex products?
Well, I think binary options are almost by definition a really simple product. So, you know, the extent to which that's going to be a jumping off point for people who want to get further involved in traditional, you know, foreign exchange, I'm not quite sure they equate. You know, the person who trades a binary is not a guy who's going to be a systems trader, you know, looking to make money on a kind of technical environment of foreign exchange. I think they're much more of a opportunistic, let's put it kindly, trader. And, you know, in the same way, does that mean that it's sustainable, that it lasts, that it's a big growth business? I really don't know. It's new enough. But by the same token, the concept has been around and it hasn't really had a lot of traction over the period of time that it's been. Maybe it attracts an audience, but I don't think it's the mainstream foreign exchange audience.
All right. Any other comments on options? And how about NDFs? The future of NDFs and NDFs taking over as a profit center going forward. What are your thoughts on NDFs? Joe, do you have?
The NDFs is it's a big part of our growth strategy, and it has been for a couple of years. You know, the average profitability on a euro trade is in the single-digit dollars in many cases, particularly for the high-volume clients, whereas the NDFs present a profit margin paradigm that we want to go after, as well as with options as well, not binaries, but with other vanilla puts and calls is more of our business on the option side. But NDFs is where we want to grow our business, and there's sort of a big question mark about how the NDF market's going to shape up as the regulations get fully implemented. You know, NDFs, if they have to trade on SF, it really puts the whole business in jeopardy. So there is a big question mark of what the future of the NDFs are going to be in terms of for companies like mine.
Yeah, I mean, I think from as a platform, currently a spot only platform, we're always looking at ways to leverage the technology and expand into other product types, and clearly, the NDF currencies in particular, options as well are areas that, we've certainly been looking at for quite some time. I think the business case for them has certainly changed over the last, call it 2 years in the environment we are now, that you now need to not just figure out, hey, is there a good business opportunity here? You need to make sure you can justify all the new regulatory expense and overhead you're going to have to take on through that. But, we certainly hear a lot of great chatter from our clients, which we use as a major driver of helping us steer the direction as far as, knowing that we're going to build a product that someone's going to want to actually use, of interest into NDFs. And it's an area that we're looking at very closely. But again, it's weighing this balancing act right now of, markets that are shifting from being generally dealer dominated to a new environment, which we still don't really understand how that's going to shake out. The final CEF rules aren't even, just sort of in the process of coming out, any day now, if you will, right around now. And everyone's got to digest that and see what that actually means. Will they migrate to centralized marketplace? Well, that's great. Then I have a solution for that. If it doesn't really happen, you're probably not going to get the critical mass you need to justify having the business, hiring the compliance officers you need, making the rule book, all that thing you need to do to be a CEF. So the equation in doing that analysis has changed dramatically in those products. But I do think they do offer great growth potential, but the regulatory framework is really going to drive it.
The impact of the regulatory framework is important because, as you say, it's all the banks that have invested in putting NDFs on their single dealer platforms could potentially not be in a position to offer that to any of their U.S. clients. But the key with NDF markets, and particularly electronic NDF markets, is that the core price, the underlying inter-dealer pricing for those markets does tend to be still very much broker and voice driven. Brazil, for example, is different. There is an electronic price source for that, and that's a market that you can participate in electronically quite effectively. But the Asia NDF markets, that's something that's a little bit more challenging. Nomura is a very active market maker in both Latin America and Asia. And we have invested heavily in our technology of being able to stream prices and being able to transfer the prices from our trading desks to effectively our clients. But if the underlying market, the underlying broker market that's determining the price for these currency pairs is not reliable, then you have a problem.
Being flagged by for audience questions. Before we go on to our last question, we're running short on time. We'll discuss your outlook for the next year, but do we have any questions from the audience at this time? Crickets? Okay. Okay, well, let's move on then. So the outlook for next year, we've discussed quite a few different things in terms of regional growth, products, inhibitors to growth, and volatility. We'll just go through and from everyone's viewpoint, what do you see happening 12 months from now, and where will the markets be? Joe, you want to start?
Well, if the volatility continues, we can go back to some growth path. I mean, if the volatility doesn't continue, we're going to have probably a big problem. I think that a lot of, particularly for medium-sized players, I think some of the medium-sized customers last year were breaking even to trading and were incurring losses due to their overhead. And I think that because of the year before and the years before, they could withstand 12 months of pain, maybe even 18 months. I think you're going to start seeing, if the volatility doesn't come here to stay, you will probably see some of those medium-sized players exit the business. But if volatility grows and we can see it continue, now I think we could start attracting more people into the market and the business can start growing. So I think I think everybody here is long vol. And so we got to hope, our bet pays off.
Mm-hmm. Thanks.
I echo Joe's comments in terms of whether volatility will be here with us or not, and I think we're all hoping that it is. From Nomura's standpoint, where we'd like to be in the next year or two is we'd like to continue monetizing the very unique space that we occupy in the marketplace. We'll continue expanding into Asia and Latin America. Those are our two big growth areas for the electronic market business. Also we'll continue monetizing the value-add services that we spend a lot of time developing for our clients. So our algo suite and some of our participation strategies and more sophisticated order types. Those are the things that in a low volatile environment will still help us continue to monetize the lower volume that we're capturing.
I think in the platform space, I think there's sort of two themes that come to mind. One being diversification, the other being customization. These aren't necessarily new terms to the space by any means, but certainly this year, there's a lot of new platforms that were announced 12, 18 months ago that will be coming live. The success or failure of those platforms, is yet to be understood, but it's certainly going to create a new environment as far as the platform space go, of diversity of venues to trade out, all with trying to bring different value propositions to the markets, and then you have incumbent players adjusting to that, coming up with their own new solutions as well. So I think it's a very exciting time as far as platform diversity, and then it'll take time for that to shake out. At the same time, I think you're seeing, certainly among a lot of the incumbent players, diversification of product, where I think you're seeing that play out at Reuters and EBS with their acquisitions and their reshuffling. They're trying to do more than be a one solution provider. They're trying to get into ancillary services on the side, hit a couple different kind of workflows. So I think you're going to see more of that type of activity. And on the customization front, I still think that's really where the successful platforms are going to execute best, which is providing real customized solutions to their clients. I think the market has sort of uniformly been showing by shifts in market share and activity that a one-size-fits-all solution doesn't really tend to fit. And people that can execute on that and deliver multiple types of solutions for the clients. They may all want to consume spot FX, but they want to consume different types of liquidity, interact with different types of counterparties. And if your technology allows you that flexibility, again, those are themes I think you're going to see throughout this current year and driving into the next couple of years as well.
I echo those comments to some extent. I think that the opportunity lies in the platforms that can provide a sort of a complex ecosystem of participation. I think there is a sort of a place for everyone, as long as you sort of manage that ecosystem effectively, so that everyone can contribute to the overall sort of health of that particular platform. That requires constant innovation, so that you can actually satisfy the requirements of those participants, which are different. So the whole flexible solutions is definitely sort of needed out there. And again, one size fits all, I completely agree. It is not true within the FX marketplace. We've expanded the sort of participation base so enormously over the last 10 years, which I think is the real driver of FX volume growth, has been this access to liquidity that people didn't have before, and that's been entirely achieved through the electronification of things like electronification of give-ups and so on, so that prime brokers can act as intermediaries to get liquidity out to guys who previously wouldn't have access to that unless they were actually a bank. So building on this ecosystem is something that we're very much focused on. So constant sort of technological innovation. But I think that the regulation is this gigantic unknown. What will it actually ultimately be? How will that be interpreted? What will be the consensus around the rules when they actually do finally arrive? Is the big sort of the big unknown that's hanging out there. Are they going to absolutely trash the FX market by accident? I think that there's a possibility. So on the one hand, satisfying our customers' requirements, while at the same time effectively handling this constantly changing regulatory environment that we're facing. Are sort of the two big themes we see over the next 12 months.
Thank you.
I think on the retail side, it's a slightly different equation. And I say this because clearly volatility is a factor, but it's not the only factor in retail, because in what we're seeing, we actually have an evolving type of customer base going on in retail right now, which is maybe different than probably we've ever had. And I say that in context of what, let's say, the original kind of retail user we used to be. A number of years ago, it was a casual user, pretty unsophisticated. It was a big moving market. Let's all do it. And there was so many that it didn't matter that they lost money. They were just replaced. Well, okay, you kind of came to the end of that cycle, and it coincided with volatility going down. So relatively, you could say that customer retail volume went down. Well, at the same time, what's happened in the past year or so, we've seen this kind of evolving group of what I'll call this social trading type of platforms or users come about. And they've kind of filled in this gap of saying, well, if you're going to have casual users who aren't self-directed, let's hook them up with people who they can actually follow, who they can trade with, and who can organize them in a more reasonable fashion. And this is kind of an interesting dynamic, because what it's doing is aggregating this otherwise pretty unsophisticated flow into a slightly more organized fashion through these social networks. And that's going to be a big part of what happens with retail. As these social networks put together different trading groups and different trading volumes coming into the retail space, I think it grows. I think it evolves into a bigger force than probably it was. Yeah, volatility will push that, but I think the customer base itself is actually changing a bit.
Any last comments? Well, I wanted to thank each and every one of the panelists for providing their viewpoints today. It's been a great panel. I wanted to thank FXIC for sponsoring the panel as well. Our next panel will be starting in 10 to 15 minutes about mergers and acquisitions. And thank you much for your time.
Thank you.